Usually when we talk about like a medical diagnosis, there's this comforting expectation of precision, right?
Oh yeah, like structural engineering or something.
Exactly. I mean, if you fall and break your arm, you go to the hospital, they take an x-ray, and the image just shows that unmistakable jagged white line across the bone.
Right, it's totally binary, like the bone is broken or the bone is intact. The visual evidence is just irrefutable. And psychologically, I mean, we really crave that.
We do.
We like complex systems to be visible and, neatly categorized.
Yeah.
Easily solvable.
Yeah, but then you step out of the hospital and into the world of corporate finance. Sure. Especially when you're looking at a massive, globally entrenched legacy tech company that's suddenly undergoing this forced turnaround.
Right.
Suddenly that reliable x-ray machine it's completely broken. We find ourselves looking at a diagnostic landscape that is, quite honestly, super murky.
Oh, incredibly murky.
Like, you can be handed a set of financial numbers that look genuinely amazing on the surface, right? Mm-hmm. But the underlying patient is actually being rushed into emergency surgery.
Yeah, it's the absolute definition of like diagnostic muddy waters. The surface metrics are telling you one thing, while the internal organs of the business are screaming something completely different.
Exactly.
And right now, honestly, there is no better example of that exact scenario than the massive data dump we're looking at today. I mean, regarding PayPal's Q4 2025 earnings call.
It is a textbook case of contradictory signals. I mean, we're looking at a company that fundamentally operates as like the underlying plumbing of the entire global internet economy.
Yeah.
And PayPal just dropped their fourth quarter and full year earnings for 2025, and it was a blockbuster event. I mean, it featured a surprise CEO swap right at the very top of the call, a missed earnings target that just instantly spooked the market. And this is the big one, the total outright withdrawal of their long-term multi-year financial guidance.
Which, in the corporate world is basically the equivalent of ripping up the architectural blueprints right as they're pouring the foundation of the house.
Exactly.
It sends this immediate giant signal of internal disruption. Wall Street hates that.
They really do. So look, our mission today for this deep dive is to cut through that disruption. We're taking this towering stack of earnings transcripts, financial data, internal metrics, management commentary, and we're going to translate all that dense Wall Street corporate speak into just plain language.
Love it.
We're going to hit the hard data, filter out the noise, and figure out what this actually means for your understanding of the broader digital economy and ultimately your investment portfolio. And if we hit a complex acronym, we'll stop and break down exactly how it works.
And I think the stakes here are genuinely massive. I mean, PayPal is widely considered a bellwether for global e-commerce.
Oh, absolutely.
When consumer spending on their platform slows down, it's usually this leading indicator that the broader retail sector is catching a cold, But beyond the macroeconomics, this earnings call is just a fascinating, real-time study of a multi-billion-dollar company trying to execute a massive pivot mid-flight.
Yeah, mid-flight is right.
They're wrestling with rapidly shifting consumer behaviors, aggressive new competitors eating into their international market share, and honestly, the heavy anchor of their own historical legacy.
Okay, so let's start with the loudest bombshell from the call, which it happened before anyone even started talking about the matter.
Right, the executive shuffle.
Yeah. Outgoing CEO Alex Chriss is out. Just gone.
Yeah.
And the board chair, Enrique Lores, who, many will recognize from his time serving as the CEO of HP.
Yep, exactly.
He's stepping down from the chair position to take over as president and CEO effective March 1st. And in the meantime, there's an executive named Jamie who's serving as the interim CEO just to, handle the day-to-day operations during this really brief transition period.
The timing and the precise messaging around this shakeup is really what we need to pay attention to.
How's that?
Well, interim CEO Jamie was remarkably direct on the earnings call. The board's decision was not framed as this gentle retirement or, a difference in long-term vision or anything soft.
Oh, not at all.
It was squarely based on execution. The message to the market was totally unambiguous. PayPal has not moved fast enough, and they lacked the required level of focus.
I mean, bringing in Enrique Lores sends a very specific kind of signal, doesn't it?
It absolutely does. I mean, Lores has this deep track record of driving disciplined execution and leading these large-scale, incredibly complex transformations, primarily in hardware and legacy tech environments.
Right, his HP days.
Exactly. He is known for operational rigor. So by installing him, the board is basically signaling that they ran out of patience with the previous administration. Like, they don't need a charismatic visionary right now.
No, they need a mechanic.
Yes. They need strict operational discipline to fix the underlying mechanics of the business.
Which is just wild to wrap your head around when you actually sit down and look at the top line numbers.
It really is.
Because, I mean, to the untrained eye, the sheer scale of the business looks like an unstoppable freight train.
Let's talk about the revenue and the volume here. The primary metric they use is called TPV, which stands for total payment volume.
Let's define that clearly.
Yeah, let's make sure we define that right out of the gate. So TTV simply means the total raw dollar amount of stuff that people bought using PayPal's network.
Right.
Like, if you buy a $50 pair of shoes online and use PayPal to check out, that entire $50 is added to the TPV.
Right. It's the total flow of money moving through their ecosystem. And I think it's crucial to understand that PayPal does not keep that $50.
Obviously not, yeah.
TPV is not revenue, but it is the ultimate raw measurement of their scale, their reach, and just their relevance in the global economy.
And the scale is almost difficult to comprehend. I mean, total payment volume hit $475 billion in the fourth quarter alone.
Wow.
That is a 9% increase on what they call a spot basis, or a 6% increase if you strip out currency fluctuations.
Yeah.
And let's quickly clarify what stripping out currency fluctuations means, because it's vital for understanding any multinational corporation.
Yeah, break that down for us.
So PayPal operates globally, right? They're processing transactions in euros, yen, pounds, dozens of other currencies. Well, when the US dollar is particularly strong compared to those currencies, the money PayPal processes overseas translates to fewer US dollars when they report their earnings back in America.
Right.
It makes their growth look artificially lower. So by reporting on a currency-neutral basis, they freeze the exchange rates to show what the actual organic growth of user behavior looked like. And even at a currency-neutral 6%, I mean, adding that much volume at their scale is a massive achievement.
It really is. And it compounds when you look at the full year. For the entirety of 2025, their total payment volume grew 7% to a staggering $1.8 trillion.
Trillion with a T.
Trillion with a T. And off the back of that massive volume, their full year revenue came in at $33.2 billion, which is a 4% increase from the prior year.
I mean, processing $1.8 trillion puts a company at the absolute epicenter of global commerce. We're talking about numbers that legitimately rival the GDP of mid-sized nations.
Yeah. But the deeper we dig into the profit, the more complicated the picture gets. So let's look at the bottom line.
Okay.
Full year non-GAAP earnings per share, or EPS, was $5.31. And let's quickly define non-GAAP for anyone listening. GAAP stands for Generally Accepted Accounting Principles.
Yep.
When a company reports non-GAAP earnings, they're stripping out these one-time irregular expenses like the cost of an acquisition or restructuring charges or maybe heavy stock-based compensation for their employees.
Right, all the messy stuff.
Exactly. They do that to try and give investors a clearer view of what the actual day-to-day operated business earned. And that non-GAAP EPS was up 14% year over year.
Which is incredible. I mean, generating 14% bottom line growth on $33 billion in revenue, that is the kind of performance that usually triggers celebratory press releases and skyrocketing stock prices.
Right. And to round out the financial health check, their full year adjusted free cash flow was a massive $6.4 billion. They took that mountain of cash and bought back $6 billion of their own stock in 2025,
wow,
including $1.5 billion in Q4 alone. And on top of all that, they paid their first ever quarterly dividend of 14 cents per share. I mean, they are currently sitting on a massive war chest of $14.8 billion in cash, offset against $11.6 billion in debt.
So just to summarize, you have a company generating immense amounts of free cash flow, actively rewarding its shareholders with massive stock buybacks, initiating a new dividend, and steadily growing their overall transaction volume.
Yeah, but and this is a massive, but the Q4 EPS specifically came in at $1.23. That number actually missed management's own internal guidance by 10 cents.
And the market reacted violently to that miss.
He really did.
The market sell-off following that specific Q4 miss is where the murky diagnosis really begins.
I really need to push on this because there's a glaring contradiction here that would confuse almost any retail investor looking at a high-level summary.
Okay, let's hear it.
Wait, full year EPS grew 14%. Total payment volume is up to $1.8 trillion. The company had so much free cash, they bought back $6 billion in stock and started paying a dividend to shareholders.
Right.
Why on earth is the board firing the CEO, and why is the market panicking over a 10-cent miss in one single quarter if the overarching full-year numbers look that solid?
Yeah.
I mean, it doesn't make sense on paper.
It cuts to the absolute core of how public equity markets operate. Wall Street is not a report card for past performance.
Oh, interesting.
It is entirely a discounting mechanism for the future. They do not pay you a premium for the money you made yesterday. They pay you for the growth they believe you will achieve tomorrow.
So it's all about momentum.
Completely.
Yeah.
The 10-cent EPS miss in Q4 was not just a rounding error, and it wasn't a slight miscalculation by the accounting department. It was symptomatic of a much deeper structural illness inside the company.
So what exactly drove the miss structurally?
Well, the miss was driven partly by a higher than expected tax rate, which is, largely outside of their operational control.
Sure.
But crucially, it was driven by severe pressure on their branded checkout operating income.
The branded checkout. Okay, so we're talking about the classic blue pay with PayPal button that you see when you go to buy something online.
Exactly. That blue button is the core engine of their historical profitability. It is the product that built the company in the first place. And the rate of change inside that specific, highly profitable segment was flashing bright red.
Oh, wow.
Growth was decelerating at an alarming pace. So while the macro numbers like the 1.8 trillion in total volume look fantastic, the underlying mix of where that volume is coming from, and more importantly, how profitable that volume is shifting in a highly unfavorable direction.
I see.
The board didn't force out the CEO because PayPal is in danger of going bankrupt tomorrow. They forced him out because the golden goose that prints their highest margin revenue is getting sick, and management wasn't curing it fast enough. They basically demanded a change in leadership before the deceleration of the core business became permanent and irreversible.
Okay, that clarifies so much. But if the core business is decelerating, but the total volume is still up to 1.8 trillion, where is all the growth actually coming from?
That is the big question.
I feel like this perfectly sets up the reality that PayPal is currently a tale of two entirely different businesses hiding under one single ticker symbol.
It totally is.
It actually reminds me of looking at a sprawling piece of real estate, right? Where the newly built, highly modern guest wing is spectacular and throwing great parties, but the deep concrete foundation of the original main house is just slowly sinking into the mud.
That's a great analogy.
Let's look at the guest wing first, the bullish story, because Venmo is absolutely crushing it.
Venmo is the standout success story of their underlying portfolio right now. No question.
It's wild because I remember when Venmo was just a verb for paying your friend back for half a pizza, or splitting a bar tab.
Oh, yeah.
But the financial evolution here is staggering. Venmo revenue grew 20% in 2025 to hit $1.7 billion.
Yeah.
And that is actually excluding interest income that they make on the cash sitting in people's accounts.
Yep.
Venmo active count surpassed 100 million users. Pay with Venmo volume, where you actually use the Venmo app to check out at a commercial retail merchant, is up 32%. And furthermore, Venmo debit card volume was up over 50%.
We really need to look closely at the mechanism of how Venmo makes money because it explains this explosive revenue growth. For years, Venmo was just this massive social network of peer-to-peer money transfers that notoriously didn't generate much actual profit.
Right, because it's free to use.
Exactly.
Yeah.
If you send a friend $20 from your Link's bank account, it's entirely free. PayPal basically eats the processing cost in exchange for user acquisition.
Right, so how did they flip the switch to 1.7 billion in revenue?
By heavily monetizing the commercial side of the network. So when a user chooses Pay with Venmo on a merchant's website, the merchant pays a processing fee, just like a credit card.
Oh, I see.
And when a user swipes a physical Venmo debit card at a grocery store, Venmo collects interchange fees from the payment network. Over the past 2 years, revenue from those specific commercial avenues has doubled.
That's huge.
It proves they finally figured out how to get younger, highly engaged demographics to use Venmo not just as a social tool to split bills, but as their primary daily financial interface for actual commerce.
And it isn't just Venmo that's carrying the weight either. Their enterprise payments business, which is often referred to internally as their PSP or payment service provider segment, is booming.
Yeah, big time.
And just to clarify, the PSP is the unbranded back-end technology that processes credit cards for huge multinational merchants.
Excellent.
You might not even know you're using it, right? You just type in your Visa card on a website, and PayPal's back-end architecture securely routes the money.
Most people have no idea they're using it.
That segment returned to double-digit volume growth, growing 12% in Q4 alone, and they roughly doubled their net processing yield. And on top of that, their buy now, pay later product drove over $40 billion in volume, which is a 20% growth rate.
Right. And that enterprise PSP business, which operates heavily under the Braintree brand they acquired years ago, is highly functional. But the margin on simply processing a credit card is razor thin.
Because everyone does it.
Right. So to double their net processing yield, they didn't just process more volume, they changed what they were selling.
How so? What did they change?
They attached what the industry calls value-added services. Instead of just being a dumb, invisible pipe that processes a credit card for a fraction of a penny, they're actively charging massive enterprise merchants for advanced AI-driven fraud protection.
Okay.
They're charging for automated chargeback resolution and intelligent payment routing that actually increases the likelihood of a card being approved in the first place.
Oh, that's smart.
Very smart. They exited 2025 with 16 different premium services that enterprise merchants are actively paying for, simply because paying PayPal for those services saves the merchant more money in the long run than dealing with fraud themselves.
Wow. Okay, so the picture starts to form here. Venmo is booming and finally monetizing its massive user base. The enterprise processing arm is highly functional, growing rapidly, upselling premium services. By now, Pay Later is surging.
Sounds great. Yeah.
It does. But here comes the bearish story. The dark cloud hanging over the whole company. Online branded checkout. This is the sinking foundation of the main house. We are talking about the flagship product.
Yep.
And crucially, it generates over half of PayPal's total profit dollars. But the growth there is simply evaporated. I mean, in Q3, it grew at an anemic 5%. By Q4, growth decelerated to just 1% on a currency-neutral basis.
And that 1% figure is the single most scrutinized metric in the entire earnings report. When your oldest, highest margin product drops 4 percentage points of growth in a single quarter, the warning sirens go off in every institutional investor's office.
Management actually spent a significant portion of the call breaking down the why behind this severe slowdown. They offered 3 distinct reasons. So let's dig into the mechanics of each one.
Let's do it.
Reason number 1 was U.S. retail weakness. They specifically pointed to a K-shaped economy that is heavily pressuring middle-income and lower-income shoppers.
This K-shaped economy thing is a crucial macroeconomic concept to understand right now. When economists talk about a recovery or the current state of consumer health, they often use letters, right? Like a V-shaped recovery means everything crashed and bounced back quickly.
Right.
A K-shaped economy means the economic reality is entirely bifurcated based on demographics.
So the 2 arms of the K are heading in opposite directions.
Precisely. The upper rising arm of the K represents high-income earners. Their wealth continues to grow rapidly, largely driven by asset inflation. Their stock portfolios are up. Their real estate values are up. Their wages have outpaced inflation.
So they're feeling great.
Oh, they're feeling fine. They're still spending freely on travel, luxury, and high-end services. But the downward-sloping arm of the K represents middle and lower-income consumers. Their wages have not kept up with the compounding nature of inflation over the last few years, and they are feeling a severe squeeze from higher prices for, non-negotiable necessities: groceries, insurance, rent.
And how does that specifically target the blue PayPal button? Like, why does that hurt PayPal more than anyone else?
Because PayPal's historical core demographic, the average everyday person clicking that blue button online, skews heavily toward that middle income bracket. So when that specific consumer feels the pinch of rent and grocery prices, they stop buying the extra pair of sneakers or the new tech gadget or the fast fashion online. They pull back on discretionary e-commerce. And because they pull back, PayPal feels the volume drop instantly.
Okay, that structural economic pressure makes total sense. So, reason number 2 for the slowdown. International headwinds. They highlighted macroeconomic softness in Europe, but they specifically pointed to fierce competition in Germany, which happens to be one of their absolute largest international markets.
Yes.
And they use a very interesting phrase. Management mentioned a, quote, normalization of our long-standing market leadership position.
That is a masterclass in polite corporate damage control right there.
Right. What does that even mean?
Translated into plain English, normalization of our market leadership basically means we used to have a functional monopoly here, and now we are actively losing market share to aggressive local competitors.
Wow. What is happening in Germany specifically that is causing them to lose that grip?
Well, Germany has a very unique payment culture compared to the United States. Historically, German consumers have a really strong cultural aversion to credit card debt. They much prefer direct bank transfers or direct debit from their checking accounts.
Okay, I didn't know that.
Yeah, so for a long time, PayPal served as this perfect digital bridge to make those bank transfers safe and easy online. But over the last few years, alternative, hyper-local payment methods have matured incredibly fast.
Oh, so they have other options now.
Exactly. You have local bank-supported solutions like GiroPay or open banking solutions like Sofor, which allow consumers to pay directly from their bank environment without ever needing a third-party wallet like PayPal. And furthermore, digital wallets built right into smartphones, which we'll discuss later, have aggressively targeted merchants in Europe. So PayPal is simply no longer the default, inevitable choice it once was in that massive market.
Got it. And reason number 3 for the checkout decline: a sharp deceleration in specific high-growth verticals. They mentioned travel, ticketing, crypto, and gaming. These were categories that saw massive booms for PayPal in 2024 and early 2025, but the music clearly slowed down toward the end of the year.
Yep, those cycles always swing.
But beyond the uncontrollable macroeconomy and, international geography, management admitted to something that I found incredibly candid. They admitted to severe internal operational failures. They literally call them self-inflicted deployment issues.
This specific admission is exactly where the necessity of firing the CEO and bringing in a strict operational leader like Enrique Lores comes into sharp focus.
They detailed the failure. So PayPal built a brand new, modernized checkout product for merchants to install. It was supposedly faster, the code was lighter, the interface looked better.
Okay.
But they entirely failed to force biometric adoption alongside the rollout.
Let's explain what that looks like in practice for a consumer just hunting a phone.
Right. So normally when a website upgrades its checkout, the goal is to make it easier for you to buy. But PayPal rolled out the visual redesign without requiring users to activate Face ID or fingerprint scanning to log in.
Oh, that's terrible.
Right. They kept the old system of usernames, passwords, and two-factor text messages, but they just put a new coat of paint on it. By separating the visual rollout from the biometric rollout, they severely limited the actual conversion benefits. And they compounded the error by admitting they optimized this rollout for every single merchant on their massive platform, regardless of size, rather than focusing their engineering resources on handholding their top strategic high-volume enterprise clients through the upgrade.
Honestly, this strikes at the fundamental psychology of modern e-commerce. In the online checkout world, friction is the ultimate enemy.
The ultimate enemy.
Friction is defined as any second of delay or any extra cognitive step a user has to take between deciding they want an item and actually paying for it.
Right.
If a customer is lying in bed browsing on their phone and they hit the checkout button, but then they have to try and remember a password they haven't used in 6 months.
I hate that.
We all hate it. Or they have to wait for a 6-digit text message code to arrive and manually type it in.
Yeah.
A massive percentage of them will simply close the browser and abandon their digital shopping cart entirely. I mean, global cart abandonment rates hover around 70%. It's huge.
And biometrics solve that entirely.
Biometric authentication, literally just glancing at your phone screen so Face ID can instantly approve the purchase, eliminates almost all of that friction. Management openly admitted on the call that failing to pair the new checkout design with forced biometric enablement left 2 to 5 points of conversion improvement on the table.
2 to 5 points. That's devastating in retail.
It really is.
I want to use a structural analogy here because I think it helps visualize exactly what is happening to their overall profit margins with all these moving parts, like the sinking foundation of the branded checkout versus the booming guest wing of the enterprise processing.
Let's hear it.
Okay, imagine PayPal owns a legendary high-end steakhouse. That steakhouse is their branded checkout business. It is famous, the brand is ubiquitous, and the margins are huge. They make an incredible amount of net profit on every single filet mignon they sell.
A premium product commanding a premium margin. Makes perfect sense.
Exactly. But suddenly, because of a bad economy and some terrible management decisions with the reservation system, basically, the lack of biometrics, they're losing reservations. The dining room of the steakhouse is emptying out. Growth is down to 1%.
Ouch.
However, the company as a whole is making up the total top-line revenue numbers by selling massive, staggering amounts of wholesale raw ground beef out the back door to local diners and grocery stores. That raw ground beef operation is their enterprise PSP processing business and their peer-to-peer Venmo transfers.
Okay, I see where this is going.
Right. So total revenue for the company is technically up. Total pounds of meat sold is up. But the internal profit mix is getting completely squeezed because selling bulk ground beef just doesn't carry anywhere near the margin of selling a plated filet mignon.
That is a highly accurate way to conceptualize the internal mechanics of their financials.
Oh.
I love that analogy. In the payment processing industry, we actually measure that specific profit squeeze using a metric called the take rate. During this fourth quarter, PayPal's transaction take rate declined by 9 basis points, dropping down to 1.65%.
And let's define a basis point for anyone who doesn't live in a Bloomberg terminal.
Good call. A basis point is simply 1/100th of a single percentage point. So a drop of 9 basis points means their take rate fell by 0.09%.
Which doesn't sound like a lot.
It doesn't sound like a lot to a normal person,
Yeah.
but at scale, it's massive. What this means in plain operational language is that PayPal is extracting slightly fewer pennies out of every single dollar that gets processed through their massive network pipes.
Right.
And exactly as your steakhouse analogy highlights, this decline is largely happening because the lower margin wholesale businesses, the back-end enterprise processing, and the massive volume of Venmo transfers are growing at double digits, while the highly profitable branded checkout steakhouse is stalling out at 1%.
It's totally dragging down the average.
Yeah.
But amidst the self-inflicted wounds and the margin compression, there was one operational metric that showed genuine improvement. Their transaction loss metrics got better. Transaction loss went from 9 basis points down to an impressive 6 basis points.
Which is a massive testament to the underlying capability of their engineering and risk management teams.
Oh, for sure.
Transaction loss is the money PayPal simply has to eat when a transaction goes bad, usually due to outright fraud, stolen credit cards, or malicious chargebacks. Dropping that loss rate by 1/3 means their internal artificial intelligence, their machine learning models, and their fraud detection systems are working exceptionally well at identifying and blocking bad actors before the money even moves.
Which is great.
It is. They are saving the company millions in preventable losses.
But saving money on fraud, while objectively excellent, is just a defensive maneuver.
Right.
It cannot entirely make up for a shrinking profit margin on the core offensive business. I mean, if you leave 5% of checkout conversion on the table because you fumble the biometric rollout, that is the difference between a massive enterprise merchant loving your platform and that same merchant abandoning you for a seamless competitor like Apple Pay or Shop Pay.
Precisely. You cannot shrink your way to massive growth.
No, you can't. Okay, so the board and the incoming CEO, Enrique Lores, know the branded checkout is bleeding. They know they messed up the rollout, which leads us directly into the absolute bombshell they dropped regarding how they plan to fix it and what they expect the near future to look like.
Management guidance.
Management guidance, or as I like to refer to it, ripping off the Band-Aid.
This was the specific portion of the call that truly sent shockwaves through the institutional investor community.
Management officially, on the public record, withdrew the multi-year 2027 financial outlook that they had literally just provided to investors at last year's highly publicized Investor Day.
They just walked it right back.
They entirely scrapped the long-term roadmap. They told the market they are throwing out the old projections and will now only provide financial guidance one single year at a time. And their outlook for this upcoming year, 2026, they are officially, bluntly labeling it a transition year.
Oh boy. When a massive publicly traded company uses the phrase transition year, it is universally understood Wall Street code.
What's cool?
It translates to things are going to look incredibly messy, our operational expenses are going to spike, our profits might actually go down, and you need to give us a 12-month hall pass to tear up the foundation and fix the underlying infrastructure.
And the hard projected numbers for 2026 reflect exactly that level of pain. They expect their transaction margin dollars to decline slightly or, at best, remain roughly flat.
Right.
Non-GAAP EPS, which remember just grew 14% this past year, is now guided to range from a low single-digit decline to slightly positive. And their non-transaction operating expenses will actually grow by about 3%.
So expenses up, profits down.
Exactly. You have a scenario where profits are guided flat to down while expenses are guided up. But to be fair, they didn't just offer bad news and ask for blind faith. They outlined a very specific structural turnaround strategy. They have 3 distinct pillars designed to fix the branded checkout.
Let's hear them.
Pillar number 1 is titled Experience.
And this pillar directly addresses the self-inflicted wound regarding the lack of biometrics we discussed earlier.
Right. They are actively, forcefully pushing consumers to become checkout ready with biometrics. Currently, they noted that about 36% of their massive consumer base has biometric passkeys successfully set up. Their stated goal is to force that number to 50% by the end of 2026.
And the mechanism of how they plan to achieve that transition is really critical. They explicitly stated they are changing their software integration strategy entirely.
Okay.
They will no longer roll out the new checkout experience sequentially, meaning giving the merchant the new visual design first and worrying about biometrics later. They are tying the two code bases together now.
Ah, smart.
If a merchant upgrades their site to the new PayPal checkout, the campaign to prompt the user to activate Face ID or a fingerprint passkey launches simultaneously.
So you can't avoid it.
Right. They recognize that they have to close that friction gap immediately, or they will continue to lose volume to competitors who already have biometrics built right into the phone's operating system.
Pillar number 2 of the turnaround strategy is called presentment. This is fascinating to me because it is entirely a battle over digital real estate. They are essentially paying or aggressively negotiating for upstream placement on merchant websites.
Let's explain what upstream means in the context of user experience, because it's a huge shift.
Exactly. When you shop online, the traditional flow is you browse, you add an item to your cart, you click the cart icon, you enter your shipping details, and then at the very bottom of the very last page, you are presented with a list of payment options, right? Visa, MasterCard, Amex, PayPal, that is downstream. What PayPal wants is to secure placement upstream. They want the consumer to see a dynamic message that says, buy now, pay later with PayPal, or a second prominent PayPal checkout button early in the shopping process, maybe right on the individual product page next to the price of the shoes before you even add it to a cart.
Exactly.
And management noted on the call that when they actually secure these upstream placements, they see more than a 10% lift in branded checkout volume.
Which is huge.
Yeah.
And you have to think deeply about how human beings actually shop online today.
Yeah.
By the time you navigate through 3 different pages to get to the final checkout screen, you might have already mentally committed to using the credit card that your web browser has conveniently auto-saved for you.
Oh, for sure. Chrome does it automatically.
Exactly. PayPal is realizing the hard truth. They can't afford to just wait patiently at the finish line anymore. They have to actively influence the consumer's psychological choice while they are still browsing the aisles. But that strategy requires intense manual negotiation with the merchant. It often requires PayPal to share some of the upside revenue or actively lower their fees to win that prime screen space.
So it's not cheap.
No, it's a literal battle for millimeters of real estate on a mobile phone screen, and it is incredibly expensive to fight.
Which perfectly bridges into pillar number 3, selection and loyalty.
Yeah.
They are rolling out a brand new initiative called PayPal Plus. It is a new global rewards program launching in the US and Europe in 2026.
Right, the rewards play.
They've been conducting early quiet tests of this program in the UK, and management claims it is already showing organic, mid-single-digit volume bumps for the users who actively enroll. The strategy is simple. Give people a tangible financial reason like cashback, exclusive merchant points, or special access to actually bypass their saved browser credit card and intentionally choose the PayPal button.
And this ties directly back to that 3% increase in operating expenses we highlighted in the 2026 guidance. This is the vital context that investors need to grasp here. The flat or downward profit guidance for 2026 isn't purely because they're organically losing business to competitors. A significant, deliberate portion of that roughly 3 full percentage points of headwind to their operating margin is a conscious choice to execute massive reinvestment into the branded checkout experience.
They're paying for it themselves.
Yes. They were spending heavily on co-marketing campaigns with merchants to secure that upstream presentment, and they are using their own balance sheet to fund the cashback rewards for PayPal Plus.
Wow.
They are actively choosing to spend money and sacrifice short-term profit right now in order to stop the bleeding, rebuild the habit loop for the consumer, and secure their long-term relevance.
I want you to put yourself in the shoes of a retail investor right now. Like, imagine you are holding a significant amount of this stock in your retirement account.
Okay, I'm imagining it. It's stressful.
It is. When a company abruptly pulls its long-term guidance, fires the CEO, and tells you, hey, profits will be flat to down next year because we need to spend heavily to reinvest in our core product. That is essentially asking Wall Street to trust them while they completely gut and renovate the house you are currently living in.
Yeah, that's a tough ask.
How long does the public market usually tolerate the noise, the dust, and the expensive construction before they just sell the house and move their money elsewhere?
That is the multi-billion-dollar question. And the honest historical answer is, Wall Street has exceptionally little patience, especially in the hyper-competitive tech sector. The market demands quarter-over-quarter perfection.
Which is impossible right now for PayPal.
Exactly, which is exactly why Enrique Loris was brought in to replace the previous CEO. The board looked at the sluggish pace of the ongoing renovation and basically said, this is taking far too long, the contractors are disorganized, the strategy is scattered, and the institutional investors are getting dangerously restless.
So he's the new foreman.
He's the new foreman. The new mandate under Loris is strict, ruthless capital allocation and disciplined execution. Remember earlier how they admitted they were trying to optimize the checkout rollout for every single merchant, big and small?
Yes, the scattershot approach that completely failed to move the needle.
Right. Under the new disciplined strategy, they are creating highly specialized, dedicated strike teams of engineers and account managers focused entirely on their top strategic enterprise merchants.
Okay, much more targeted.
Yes. They noted that this specific top-tier group currently represents roughly 25% of their total volume, but holds the potential to be much larger if optimized correctly. So they are halting the broad, unfocused, democratic efforts and concentrating all of their heady firepower where it will move the financial needle the fastest.
That makes a lot of sense.
They are asking the market for patience, yes, but they are attempting to demonstrate urgency by changing leadership and radically narrowing their operational focus.
Here's where the narrative gets really interesting, though, because while they are desperately trying to fix the leaking plumbing of today, they are quietly placing a massive, highly speculative bet on the internet of tomorrow.
Yeah, the AI stuff.
Management noted that while it won't impact the messy 2026 revenue, PayPal is investing heavily in something they call agentic commerce.
Agentic commerce. This is the absolute frontier of digital economics.
It sounds like pure sci-fi. The core idea is allowing AI bots, basically artificial intelligence agents operating on your behalf, to literally buy things for you without your manual input.
It's wild.
And they announced strategic partnerships on the call with Perplexity and Microsoft Copilot. They are actively integrating a product called StoreSync, and they are outright acquiring a tech company called Symbio to bring this specialized capability in-house.
If we zoom out and connect this to the macro evolution of commerce, it actually makes perfect sense. I mean, we went from physically walking into a brick and mortar store to clicking a mouse button on a desktop website to tapping a piece of glass on our mobile phones.
Right, it just keeps getting easier.
The next logical, inevitable step in the relentless pursuit of removing friction is removing the human physical action entirely. Agentic commerce envisions a world where you simply tell your AI assistant, verbally or through text, hey, I need more running shoes, you know my size and my preferred brands, find the best price online and buy them.
And it just does it.
And it just does it. The AI goes out, scans the entire internet, negotiates the cart, and seamlessly completes the transaction in milliseconds. PayPal wants to be the universally trusted identity catalog and the default secure payment pipe that these AI agents use to transact.
Wow.
It is a brilliant and necessary hedge against the eventual death of the traditional visual checkout button.
Which is wild to think about. A world where the button doesn't even exist.
Oh, okay. We have covered a massive amount of highly complex ground today.
We really have. We have broken down the hard headline numbers and the CEO swap. We explored the underlying story of the two PayPals, the booming Venmo and enterprise businesses versus the sinking branded checkout. We unpacked the cautious, painful, investment-heavy guidance for 2026, and we just touched on the futuristic AI bets.
That's a lot to digest.
Now it's time to deliver the verdict for the retail investor listening to this. Are we looking at a fundamentally bullish or a bearish scenario?
As with any massive corporate turnaround, evaluating the scenario requires holding two entirely competing truths in your mind at the exact same time. Let's start with the bearish short-term view because that is the immediate reality.
Give it to me straight.
The immediate 12 to 18-month reality is objectively tough. With EPS projected to dip or stay flat in 2026 and the comforting 2027 multi-year guidance entirely scrapped, momentum investors, the large funds that buy stocks simply because the underlying metrics are going up quickly and reliably, will likely step away from PayPal entirely.
Yeah, they're gone.
The macroeconomic environment, specifically that K-shaped economy heavily pressuring their core middle-income consumer base, is not going to magically fix itself overnight. Furthermore, the competition from alternative payment methods, especially the fierce local bank transfer competitors in massive international markets like Germany, is deeply entrenched and highly motivated.
Right.
PayPal is no longer the shiny, nimble new disruptor. They are the heavy, legacy incumbent desperately defending their castle against a swarm of younger attackers. 2026 is going to be messy, expenses are going up, and the public market generally hates uncertainty more than anything else.
That is a highly sobering, realistic view of the immediate challenges. But what about the bullish long-term view? Because looking at the sheer cash generation, it's not all doom and gloom.
Absolutely not. The bullish case is deeply rooted in their almost unfathomable scale and their sheer cash generation capability.
The $6 billion in free cash flow.
Yes. Venmo is a $1.7 billion powerhouse that is finally definitively being monetized effectively. Getting 50% volume growth on the physical Venmo debit card proves they can successfully cross-sell traditional financial products to a younger, highly skeptical demographic.
Which is notoriously hard to do.
Very hard. And their enterprise PSP business is highly functional, continually adding value-added services and actively winning market share in the massive unbranded space. And most importantly, despite the severe headwinds facing the branded checkout button, the company as a whole is still generating over $6 billion in free cash flow annually.
Right, which they are using.
They are aggressively using that mountain of cash to buy back their own stock, which physically reduces the total share count, thereby artificially supporting and boosting the earnings per share metric. And they are actively paying a newly initiated dividend. That massive, reliable cash flow provides a huge margin of safety for long-term investors.
So let's make this highly actionable for the listener. If you are listening to this deep dive right now and you are currently holding PayPal stock in your portfolio, what should your mindset be?
It's all about patience.
Based on the data, it seems like you need to brace for a highly bumpy 2026. This is the textbook definition of a classic transition year story. However, the newly initiated dividend and those massive $6 billion stock buybacks offer a tangible floor.
Yep.
They offer significant downside protection while the transition happens. But fundamentally, if you are holding the stock, you are no longer betting on the legacy momentum. You are now entirely waiting on the new CEO, Enrique Lois. You are waiting to see if his reputation for strict, disciplined execution can actually force this biometric adoption, integrate those top-tier enterprise merchants, and fix the plumbing.
Precisely. If you are holding the stock today, you are essentially being paid a small recurring dividend to sit patiently in the living room while the new CEO radically renovates the foundation of the house around you.
And what if you are considering buying? If you are sitting on the sidelines looking at the recent drop in the stock price and wondering if this is a value play.
If you are looking to enter a new position, PayPal is the ultimate show-me stock right now. Management has made incredibly big promises about a structural turnaround. They have outlined a logical three-pillar strategy, but they haven't proven they can actually execute it yet.
Right.
The self-inflicted wounds of past years suggest caution. My advice would be to keep it on a highly active watch list and aggressively monitor the next 2 quarterly earnings reports. You are looking for one specific vital metric above all others: the online branded checkout volume growth.
You are looking for that terrifying 1% number to move.
Exactly. If that branded checkout growth metric stays stuck at 1%, or worse, if it drops into negative territory in the coming quarters, it means the turnaround strategy is failing, the heavy investments in marketing and upstream presentment aren't working, and they are organically losing market share to competitors faster than they can patch the holes in the boat.
That would be bad.
But, however, if that metric stabilizes and ticks back up toward the mid-single digits, say, hitting 4% or 5% growth by the end of the year, it is the ultimate, undeniable signal that the heavy investments in biometrics, upstream digital real estate, and PayPal Plus rewards are actually changing consumer behavior.
And if that happens?
If that happens, given their massive underlying cash flow and discounted valuation, the stock might be significantly undervalued right now.
So, to synthesize and wrap up the absolute most important takeaways from this entire incredibly dense deep dive into the corporate X-ray. Number one, you have a new highly disciplined CEO coming in who is strictly focused on execution and prioritization, aggressively moving away from the failed scattershot approach of the past.
You're the new foreman.
Number 2, their core historical profit engine, the branded checkout, has slowed to a terrifying 1% growth rate, forcing them to sacrifice short-term profit to reinvest heavily in the user experience.
Makes sense.
Number 3, Venmo and the unbranded enterprise businesses are absolutely booming and successfully carrying the top-line revenue numbers for the entire company. And number 4, 2026 is officially designated as a flat, noisy, expensive transition year while they try to fix the sinking foundation.
That is a perfectly comprehensive synthesis of the reality on the ground. Investing in a corporate turnaround of this sheer scale requires immense stoic patience.
Definitely.
The core utility of PayPal is absolutely not dead. Processing 1.8 trillion in global volume definitively proves that the network is highly relevant. But the golden days of easy, frictionless e-commerce dominance, where they were the only trusted game in town, are permanently over. They have to fight fiercely, aggressively, and expensively for every single millimeter of screen space on a merchant's website now.
It's a whole new, highly combative world. And that brings me to a final provocative thought I want to leave you with, something to mull over that goes far beyond the immediate quarterly numbers or the 2026 guidance.
Okay, let's hear it.
We spent a lot of time today talking about the fierce battle for the blue checkout button, the upstream presentment, the biometrics, the fight for screen real estate. But what if the ultimate future of PayPal isn't about that iconic blue button on a website at all?
What is the alternative to the button?
Think deeply about their push into agentic commerce, the strategic acquisition of Symbio, the deep integration with Microsoft Copilot and Perplexity. What if the new leadership at PayPal realizes that the visual interface, the very concept of a human clicking a button on a screen, is a rapidly dying paradigm?
Oh, wow.
What if their ultimate long-term survival relies entirely on abandoning the visual war and becoming the invisible default wallet for AI agents? Imagine a world just 3 or 4 years from now where you don't even click checkout anymore. You never see a cart page. You never type in a shipping address.
It just happens.
Exactly. Your personal AI just seamlessly buys your weekly groceries, books your complex international plane tickets, and orders your specific running shoes seamlessly in the background, using PayPal's trusted, secure back-end plumbing to execute the financial transaction. As the war over the branded button gets bloodier, more expensive, and more crowded with competitors like Apple and Google, the real trillion-dollar gold mine might be in abandoning the screen entirely and becoming the foundational, invisible financial API for artificial intelligence.
That is a profound shift in perspective. It suggests that if the diagnostic X-ray looks murky to Wall Street today, it might simply be because the patient is rapidly evolving into a completely different species of company.
Exactly. The plumbing of the internet is being relayed, and we will be watching closely to see who owns the pipes. Thank you for joining us on this incredibly deep dive into the numbers, the mechanics, and the future of PayPal. Keep questioning the headlines, look past the surface metrics, and we will see you next time.